When an earthquake hits, the first thing we all see is the physical destruction, right? The collapsed buildings, the buckled roads. But what you don't see is a second tremor, an invisible one, that rips through global financial markets. It's a shockwave that can shake a country's entire financial foundation. So, what makes one country crumble under that pressure while another stands firm? Well, that's what we're going to dig into.
So, here's the puzzle I want you to think about. An earthquake, the exact same magnitude, strikes two different countries. In country A, investors completely freak out. The cost for that country to borrow money just goes through the roof. But in country B, investors are weirdly calm. In fact, their borrowing costs might even go down. How on earth is that possible?
And that really sets the stage for what is, essentially, a tale of two very different tremors. It's this strange paradox that gets right to the heart of what really matters to markets when a real crisis hits. It's not just about the shock itself. I mean, just look at this contrast. On the one hand, a country with, let's say, weaker institutions gets hit and boom, financial chaos. Borrowing costs skyrocket. On the other side, a country with really strong institutions gets hit with the same shock and it leads to stability, maybe even a boost of confidence. The physical event is identical, but the financial result? It's the complete opposite. What gives? To get to the bottom of this, we're going to crack open the source material. It's this really fascinating working paper from the International Monetary Fund that dives headfirst into this exact question. Okay, so the paper we're looking at is called Earthquakes and Emerging Market Sovereign Bond Spreads. It's by a team of researchers, Rabah Areski, Patrick Imam, Kongni Kapodar, and Dao Li Van. And they set out to figure out, systematically, what's driving these wildly different reactions from investors. And they don't bury the lead. Right there in the abstract, they lay it all out. They say, sure, on average, earthquakes make it more expensive for countries to borrow money. But, and this is the big but, the effect depends critically on state capacity. They put it beautifully. Institutional quality acts as disaster insurance. So it's not the disaster that matters most, it's the system you have in place to deal with it. So that's a pretty bold claim, right? How do you actually go about proving that? Well, to turn a brilliant idea into a rock-solid finding, you've got to have the right evidence and you've got to have the right tools. So the researchers gathered a few key ingredients for their analysis. First, sovereign bond spreads for 96 countries. That's just a fancy way of saying a country's borrowing costs. Second, they got data on over 44,000 earthquakes. And third, here's the secret sauce, something called a state capacity index, which is basically a report card on how effective a government is. Of course, they also included a bunch of other data, like a country's income and its debt levels, just to make sure they were really isolating the true cause. So what in the world is state capacity? Well, you can think of it as the basic machinery of government. Is the government actually good at its job? Can it collect taxes without chaos? Can it enforce its own laws? Can it deliver basic things like clean water or pave a road efficiently? It's really just a measure of competence and credibility. Now, the method they used here is just brilliant. They took advantage of the fact that earthquakes are, for all intents and purposes, completely random. They're not caused by some bad economic policy or who's in office. And that randomness makes them a perfect natural experiment. It's like a real-world stress test, a perfect laboratory for seeing how investors really behave when a system is suddenly pushed to its breaking point. And to analyze all that data, they built a series of statistical models. They started simple, just to get a baseline, what's the average effect of a quake? Then they built a more sophisticated model to ask, okay, does state capacity change that effect? And finally, they used some really advanced methods just to triple-check everything and make sure their findings were legit and not just some statistical fluke. All right, so with all the data gathered and the methods in place, they uncovered what you could call the institutional fault line. This is the moment the data reveals this deep, deep crack in how financial markets see the world. So first, this simple average result. If you lump all countries together, an earthquake makes a country's borrowing costs go up by about 9 basis points, that's 0.09%, a couple of months after the event. And that delay makes sense, right? It takes time for the full economic damage to become clear. So on average, earthquakes are bad news for a country's credit. But averages can be so misleading. They often hide the most interesting part of the story. So the researchers asked the billion-dollar question, what happens if we stop averaging and instead split the countries into two groups, those with strong institutions and those with weak ones? And here it is. This is the big reveal.
For countries with low state capacity, borrowing costs shot up by 17 basis points. A big jump. But now look at the high-capacity states. Their borrowing costs fell by 21 basis points. They went down. The exact same shock caused two completely opposite financial reactions. Investors weren't punishing countries for the disaster. They were rewarding the ones they believed were competent and resilient enough to handle it. The mystery? Solved.
So what this all boils down to is a really powerful idea. Good governance isn't some abstract concept. It's a real, tangible financial asset. It literally works like a national insurance policy against disaster.
The paper's conclusion just says it perfectly. Markets are like seismographs. They do not merely register the size of a shock, they trace how it travels through a system. You see, an earthquake doesn't just expose geological fault lines, it exposes the institutional bedrock, or lack thereof, that a country is built on.
So what are the big takeaways here? Well, first, a disaster like this is way more than an economic shock. It's an institutional stress test. Second, investors are smart. They're pricing in a government's ability to actually respond to a crisis. That means building effective, credible institutions isn't just good governance. It's one of the best forms of risk management a country can invest in. And, amazingly, it can actually lower your borrowing costs right at the moment you need that money the most. And that leaves us with this final thought to chew on. You know, we live in a world with more and more risks, from climate disasters to pandemics, and this research suggests a powerful idea. Maybe the best preparation isn't just about building stronger walls or stockpiling supplies. Maybe the ultimate insurance policy, the most resilient piece of infrastructure we could ever build, is simply a government that works.